Hello, everyone, and welcome back to the Deep Dive. I hope you are fueled up and ready for an intensive analysis because today we are strapping in to examine one of the foundational, most immovable businesses in the entire American economy. Our focus today is the industrial infrastructure titan, Union Pacific Corporation, ticker UNP. And this is, it's more than just a company. It's really the physical spine of the western two-thirds of the United States. We're doing deep dive quality analysis to understand the integrity of its competitive fortress. On the surface, UNP appears to be an irreplaceable asset, a true industrial giant defined by, physical rights of way that just cannot be replicated. But for us as long-term compounding investors, the real central question is this. Is that physical fortress truly immune to the new threats? I'm talking about technological decay, primarily from autonomous trucking, and of course the growing, often unpredictable specter of regulatory threat. That is the mission of this deep dive.
That is a fascinating and I think an utterly essential question for any infrastructure investor. How durable is the mattress, really, when it's faced with these external variables that are, non-physical? Before we get into the details of UNP's competitive position and the analysis of its balance sheet, just a brief note for you, the listener.
Yeah, we spent a tremendous amount of time synthesizing all this data. And for those of you who want to act on this kind of in-depth knowledge, having the right professional platform is absolutely key. We use several analytical tools to synthesize this material, and checking the description for ways to support the deep dive directly allows us to continue delivering this comprehensive analysis.
That support is crucial, and it really confirms that this kind of thorough, synthesized content is what you find most valuable. It allows us to keep analyzing complex giants like UNP week after week.
Absolutely. And of course, if you find value in this kind of deep exploration, the best way to let us know and to ensure you get the next deep dive delivered straight to you is to subscribe and like the content. It truly helps us grow. And if you have any burning questions regarding UNP's role in nearshoring or its regulatory exposure, please manifest your thoughts in the comments section.
Perfect. Let's start the analysis now. To answer your central question about the durability of the fortress, we have to start at the foundation. Pillar number 1, the irreplaceable fortress itself.
Okay, let's unpack this brutally simple business model because it's essential to the long-term thesis. When we look at UNP, we have to recognize that we are fundamentally looking at a toll road on steel wheels. It's a business model that, on paper, is elegantly simple. Revenue is generated by hauling just massive amounts of freight, everything from grain and chemicals to finished cars and massive shipping containers across the vast western two-thirds of the United States.
And what makes this business pass what we call the 20-year endurance test isn't just the movement itself, but the physics behind how they move it. The core mechanics are simple: volume multiplied by distance multiplied by pricing. But the longevity? That comes from minimal steel-on-steel friction.
That's it. That's the key physical advantage that no competing technology has really managed to overcome. When you have steel wheels on steel tracks, friction is reduced so dramatically that rail transport is inherently, fundamentally, 3 to 4 times more fuel efficient.
Or energy efficient if you measure in BTUs per ton mile.
Right, than standard long-haul trucking for moving heavy goods over land. The actual economics of thermodynamics favor the rail every single time.
I mean, the comparison is just staggering.
All right.
A single UNP train can carry the load of, 250 to 300 semi-trucks?
300 trucks.
The energy required to move that mass is disproportionately small compared to what it would take for hundreds of engines to push that same weight down the road, fighting pavement friction and aerodynamic drag. The structural need to move physical matter across the North American continent persists unless, as you joked, we invent commercial teleportation.
So the physics ensures the economics remain superior for high-volume, long-distance haulage. You are fundamentally betting on the necessity of physical movement, which gives this business model an inherent stability that very few industries, even high-tech ones, can claim.
Exactly. While the demand is cyclical, sure, it's tied to the industrial economy's health, but the fundamental need for the service is unquestionable. It is the definition of a required utility.
And that necessity creates the stability that allows us to move directly to the analysis of the moat.
So if the business model is enduring, let's talk about the moat itself. This is where UNP transitions from a durable business to an irreplaceable one. We define this moat using a phrase we love: an insulated real asset monopoly, or an IRAM.
IRAM. And while the West is technically a duopoly, right? It's shared with BNSF Railway. The reality is that where UNP's tracks run, it possesses what is truly an unbreachable fortress.
The defensive barrier is just the sheer physical scale and the regulatory framework that supports it. We're talking about owning and maintaining over 32,000 route miles of track
32,000 miles.
across 23 states in the western two-thirds of the U.S. And this is not just track. This is right-of-way, land ownership, easements, and infrastructure that has been built and consolidated over more than a century.
So let's quantify the impossibility of replication. If an aspiring competitor, flush with, I don't know, sovereign wealth fund cash, wanted to challenge UNP, what would it actually take?
Well, they wouldn't just need trillions in capital for steel and ties.
Right.
They would need to acquire land rights through thousands of local, county, and state governments. They would have to navigate this labyrinthine regulatory maze zoning boards, eminent domain challenges, environmental impact assessments, and thousands of local political hurdles.
It's a non-starter.
It is genuinely a physical and regulatory impossibility to build a rival network today. Even if the capital existed, the political and environmental opposition would tie up the project for decades, if not centuries.
Which makes the existing network an unparalleled strategic asset. You are buying a non-replicable piece of American economic history and, well, geography.
And this impossibility, of course, translates directly into the moat in action: pricing power. We saw a stunning recent illustration of this in Q1 2025.
Oh, this was a great example.
This quarter was brutal for one of their high-margin segments. Coal volumes collapsed by a staggering 20%.
20%.
Yeah, due to utility shifts and mild winter weather. Yet UNP managed to keep its overall freight revenue relatively stable.
How?
How? By exercising what they publicly refer to as core pricing gains, they raised prices across other segments, chemicals, intermodal, industrial products, above the rate of inflation, effectively offsetting the volume collapse in coal.
Wait, that sounds too good. If UNP raised prices aggressively while one major segment like coal was collapsing, doesn't that inherently tell us they're sacrificing overall volume growth for margin protection? I mean, is that truly a sustainable model for the economy? Or is CEO Vina just relying on their captive customer base to keep the financials padded?
That is the essential challenge. You've hit on the core tension. It is not necessarily sustainable from an economic growth standpoint, but it is deeply sustainable from a fortress integrity standpoint.
Oh.
The customers, the captive shippers, they have virtually no other viable alternative for heavy bulk movement. They are forced to pay the toll. Yes, they may grumble and file complaints with the STB, but the product has to move.
So the pricing power is really just a direct confirmation of the market's dependence on the rail duopoly.
Precisely.
Fair enough. So the moat is physically eternal. However, its utility faces slight pressure, right? Yeah. Trucking is inherently more flexible. It offers door-to-door service, better speed for high-value, time-sensitive, smaller shipments. That's the persistent leakage around the edges of the fortress.
But here's where the moat effectively widens for the future: nearshoring. As global supply chains shift and manufacturing relocates from Asia to Mexico, UNP's geographical advantage becomes a dominant strategic asset.
Ah, yes.
They are positioned as the critical logistics partner for this multi-decade macro trend.
And the specific detail here is crucial. UNP's network covers all 6 major rail gateways between the U.S. and Mexico.
All 6.
They don't just participate, they dominate the cross-border movement of goods. This widens their moat relative to most other North American rail peers and certainly relative to long-haul trucks, which face, increased cross-border regulatory and labor complexity.
To truly appreciate this asset, we need to think conceptually. You often remind us that the financial statements, they're just the map.
Exactly. The concept of the map is not the territory, popularized by Alfred Korzybski, is essential here. Investors spend hours poring over the income statements and quarterly reports. That's the map. But the true irreplaceable value of Union Pacific lies in the territory, the physical real estate, the rights of way, the immutable steel lines laid across the continent decades ago.
You can't capture that value in an Excel cell.
No. You own American geography, and that is a value that cannot depreciate. It can only appreciate with inflation.
Furthermore, we can apply Newton's first law of motion to the economics of this business: inertia.
Okay.
The massive initial capital expenditure, the billions spent a century ago building the tracks, acquiring the land, constructing tunnels and bridges, installing complex signal systems, all of that created enormous inertia. It was incredibly hard, slow, and capital-intensive to start.
So once that massive foundational work is complete, once the train is moving, the business generates immense operating leverage. Consider the cost structure. The locomotive, the tracks, the signaling system, the initial crew. These are all massive fixed costs.
So the marginal cost to add one more freight car to a 100-car consist is?
Negligible.
It's negligible. That's the key. You're already paying for the fuel, the maintenance on the tracks, and the crew. Adding that 101st car requires almost no additional labor or capital outlay, meaning any marginal increase in volume drops almost straight to the bottom line.
Which leads to spectacular efficiency and maintaining those high margins.
That operating leverage is what allows them to generate such strong returns, which we will analyze shortly. The high initial cost created the physical moat, and the moat allows for marginal volume expansion at near zero marginal cost.
Again, a powerful compounding machine.
Exactly. Now let's step outside the finance department for a moment and run a Scuttlebutt simulation. What are the actual customers and employees saying?
Right.
First, the customer view. It's important to understand that shippers view UNP as a tolerated necessity, not a beloved service partner.
That's entirely accurate. I mean, if you look at the filings with the STB, the Surface Transportation Board, they are often riddled with complaints.
And not just about price.
No, not just about price. They are about service variability. Common frustration points include severe service delays, the use of embargoes.
Can you explain embargoes?
Sure. That's where the railroad actually limits shipments to clear severe congestion, which obviously frustrates customers who need to move goods immediately. And then there's just a general lack of service flexibility.
This system is designed for efficiency, not customer satisfaction. And the frustration level rises because the shippers are, by definition, captive.
Think about it. Consider the massive grain elevator operator in Nebraska or Kansas. They harvest millions of bushels of corn destined for export to the Pacific Rim or the Gulf Coast.
You can't move that with trucks.
You cannot efficiently move that corn using hundreds of semi-trucks. It would lead to massive logistics, headaches, spoilage, and just astronomical costs. The sheer volume and distance demand rail.
So they have to use Union Pacific.
They must use them, regardless of service frustration. The moat holds even in the face of customer dissatisfaction because the alternative is economically non-viable.
Now we shift to the employee perspective, where the tension is acutely felt, especially concerning social risk. And this all centers around the aggressive implementation of precision scheduled railroading, or PSR, under CEO Jim Vellana.
Wall Street worships PSR. They love it because it is an efficiency machine. It cuts costs, liquidates unused assets like classification yards and locomotives, and drives down the operating ratio.
But the unions
criticize it vehemently because it fundamentally changes the nature of the job.
The core method of PSR involves shifting from, say, shorter scheduled trains running frequently to running far longer trains far less frequently, maximizing tonnage per train.
Right, and that reduces the number of trains required, which means fewer crews are employed and fewer classification yards are needed.
The human cost of this efficiency is the critical risk. Unions point to grueling schedules where crews are on strict attendance policies and often on call 24/7. When a train is delayed, workers are forced into intense, long shifts to avoid missing mandated schedule windows.
This efficiency versus morale tension is a critical social risk that investors really have to track.
A disgruntled workforce, particularly in an industry that relies on highly skilled, focused labor to maintain safety and efficiency on a fixed schedule, it increases the risk of accidents, serious operational snarls, and most importantly, the threat of a crippling nationwide strike.
Or government intervention mandating staffing minimums.
Exactly. It's a necessary tension for maximizing profit, but it comes with a definite social and regulatory cost that must be monitored.
Looking at the competitive landscape, it's remarkably simple, which reinforces the duopoly nature of the business. In the West, UNP is essentially a duopoly, competing directly with BNSF Railway.
BNSF, of course, is the rail arm owned by Warren Buffett's Berkshire Hathaway, which adds another layer of competitive intensity and deep, permanent capital. They are the only other Class I competitor in the Western network.
So the two companies essentially just divide the entire Western U.S. rail freight market.
Pretty much. Beyond that duopoly, the primary competitor for shorter distances and lighter, high-value loads is long-haul trucking.
But UNP maintains a durable advantage over both. Against BNSF, UNP's specific geographic franchise gives it superiority in two crucial areas. We mentioned the Mexico exposure accessing all 6 major gateways, which ties directly back to that nearshoring thesis.
And the second one.
Secondly, their prime location within the vital petrochemical complex of the Gulf Coast gives them an edge in high-margin chemical transport.
And against trucking, we return to the thermodynamics we discussed earlier. That simple physical advantage is just It's enduring.
We are talking about using 1 gallon of diesel to move 1 ton of freight 400 to 500 miles.
Compared to what, maybe 150 miles for a truck?
If that. That economic reality means the cost differential against trucking is massive and permanent, especially as environmental regulations tighten and the cost of fuel remains volatile.
So for the bulk of what UNP moves, commodities, intermodal containers, heavy industrial goods trucking is simply not a competitive economic option past a few hundred miles.
So Pillar 1 confirms. The fortress is physically unreachable, translationally powerful through pricing, and strategically positioned for future macro trends like nearshoring. It's a fantastic asset.
Agreed. Now let's move to Pillar 2, which examines the quality of the stewardship, who is running this fortress, and how efficiently are they allocating its massive cash flow.
When we talk about UNP's leadership, we have to talk about Jim Vina. He returned as CEO in 2023, and his arrival immediately signaled a hyper-focus on operational excellence.
Vina is a known disciple of the late Hunter Harrison's revolutionary approach to railroading, precision schedule railroading, or PSR.
His philosophy is singular. Ruthless optimization of every single piece of rolling stock and rail mile.
I mean, his public statements are relentlessly focused on two metrics: velocity, how quickly assets move through the network, and asset utilization. He is obsessively detailing his plan to drive down the operating ratio, or OR, and reduce dwell time.
And for the listener, the operating ratio is simply operating expenses divided by revenue. It's the closest measure of efficiency in the rail business. A lower number is always better.
Right, and dwell time directly impacts customer service and asset utilization. Vina is a cold, calculated operator whose success is measured purely by his ability to squeeze more throughput from the same or fewer assets.
And that operational focus is exactly the right fit for a mature, capital-intensive rail. This business doesn't need a visionary who wants to diversify into tech logistics or acquire new businesses.
No.
You need a world-class operator who can squeeze every last drop of efficiency out of an existing fixed network. Vina's job is to manage capital, cut costs, and improve the return on the existing infrastructure. He is a financial sculptor, carving profit out of existing stone.
And the underlying goal is not growth, it is margin expansion. By driving down that OR, he can deliver significant earnings growth even in a flat volume environment, which is the immediate controllable lever UNP possesses.
So let's look at the incentive structures. How is management actually compensated? We see compensation heavily weighted toward achieving specific financial targets: high return on invested capital, ROIC, and critically tight operating ratio targets, often tied to multi-year performance goals.
This is a textbook study in incentive alignment and its inherent trade-offs. The structure is perfectly aligned with shareholders who demand high efficiency and maximum capital returns. Management is financially incentivized to run the railroad as leanly and efficiently as possible.
But this same structure arguably creates massive misalignment with two other crucial stakeholders, which ties back to our earlier discussion. First, the customer, because squeezing every drop of efficiency often means sacrificing service quality, flexibility, and speed.
Which is why we see the increasing volume of complaints to the STB.
Exactly. And second, the employees. Achieving that low operating ratio usually involves strict staffing controls, long train lengths, and intense pressure on schedules, leading back to the morale and social risk we discussed.
So management's bonus check often correlates directly with the pain felt by the crews on the ground and the frustration felt by the captive shippers.
The rationality test here is key, and UNP passes it with cold, rational efficiency. When they see volume drop, the immediate rational response, dictated by Vina's PSR mindset, is to protect the margins at all costs.
That means parking hundreds of locomotives immediately and furloughing crews, sometimes thousands, to adjust capacity quickly to demand.
This may cause short-term disruption to labor and capacity, but it ensures the financials remain protected from economic cyclicality. It is the necessary, ruthless management required in a cyclical, fixed-cost business where margins can evaporate quickly if capacity isn't managed aggressively.
Moving to capital allocation, this is where UNP shines for the long-term compounding investor. The company is, by definition, a cannibal.
That's right. They're one of the most aggressive buyback machines in the industrial sector. They have systematically, year after year, reduced their share count over the last decade.
And this systematic reduction acts as an immediate, ongoing floor for the stock price and artificially boosts per-share earnings, even if net income is structurally flat.
Their priorities are crystal clear, reflecting the maturity of the business. They pay a growing, reliable dividend, which is considered highly secure given the predictable cash flow. And they return nearly all excess free cash flow to shareholders via that dividend and those aggressive buybacks.
The only capital they retain internally is what is strictly necessary for maintenance capital expenditure. They recognize that they have few, if any, genuinely high ROIC internal growth projects left that require massive capital infusion because the network is built.
So the best use of cash is therefore to return it to the owners. This capital allocation strategy defines UNP as a predictable equity compounder, especially appealing if you can acquire the stock at a reasonable valuation entry point.
From a qualitative financial standpoint, UNP's quality is exceptional. For an industrial company, it is an efficiency machine, consistently maintaining an operating margin in the high 30s to 40% range.
To put that in perspective, that level of margin is usually reserved for technology or luxury goods, not a massive asset-intensive business moving dirt and metal.
And we can reinforce the existence of the moat by looking at their key quality ratio, return on invested capital, or ROIC. They consistently generate returns in the mid-teens, typically between 12 and 15%.
And that's well above their estimated cost of capital.
Right, which indicates that the business generates excess returns, the financial definition of a durable competitive advantage.
Furthermore, their net income converts efficiently to cash, indicating high free cash flow conversion. However, we must spend serious time analyzing the reality of their capital expenditure, a concept we refer to as the Red Queen effect.
The Red Queen effect.
Here's where we connect the analogy from Alice in Wonderland. The Red Queen says, it takes all the running you can do to keep in the same place. For UNP, they must spend over $3 billion annually, sometimes much more, in necessary Capex just to maintain the tracks.
And this is the hidden cost of the fortress. That $3 billion is not growth spending. It's maintenance Capex. It covers the replacement of rail ties, maintenance of thousands of bridges and tunnels, upkeep of the expensive positive train control safety system, and constantly battling the effects of, thermal expansion, flooding, and weather damage on the rail bed.
This cost is permanent, non-negotiable, and must be paid every single year. It is the cost of running fast just to stay in place, preventing the deterioration of the core asset.
And this high necessary Capex dampens the overall free cash flow return slightly, but is simply the cost of maintaining the 32,000-mile monopoly.
Finally, regarding the balance sheet, their net debt to EBITDA ratio hovers around 2.5 to 2.8x. While this looks high compared to an asset-light software company, it is standard and stable for a utility like rail. The cash flows are predictable, durable, and highly secured, easily supporting that level of leverage.
They can access debt at incredibly favorable rates because the market views their assets as essential.
So Pillar 2 shows exceptional management focused purely on efficiency and a financial structure built for consistent capital return, but always fighting the massive permanent maintenance requirements dictated by the Red Queen effect.
Precisely. Now we transition to Pillar 3, which is crucial for the investor. Translating this quality into an entry price and defining the risks to your capital.
Let's discuss how the market values Union Pacific. They consistently trade at a significant premium multiple, often between 18 and 22 times price to earnings, compared to the broader, more cyclical industrial market.
Yeah, which often trades closer to, 12 to 15x?
Right. So why does the market grant this premium? Because it doesn't view UNP as a pure industrial stock. It treats it as a bond with an equity kicker.
What do you mean by that?
It offers safe, predictable yield, that growing, reliable dividend, and highly secured cash flow, combined with the slow, inflation-beating growth potential of an equity that benefits from pricing power. It's a portfolio stabilizer and a hedge against inflation due to its fixed asset base.
But that premium valuation comes with a clear cost for new investors. At these high multiples, say around 20 times PE today, the price inherently assumes perfect execution from Vini's efficiency team and a relatively stable, growing industrial economy.
And the nearshoring volume.
Right, supplemented by that nearshoring volume.
And here's the downside scenario that the premium introduces. If the industrial economy slows significantly, or if the nearshoring thesis gets delayed, if those massive manufacturing shifts take longer than anticipated, earnings growth stalls.
And if earnings stall and the industrial sector becomes cheaper overall, that multiple could contract sharply, possibly falling back down to the 15x industrial average.
If that multiple compression occurs, even if the underlying business quality remains intact, you could find yourself in a scenario where the stock becomes dead money for 3 to 5 years, just waiting for cumulative earnings growth to catch up to your high entry price.
That's the risk of buying quality at too high a price.
So how do we define a margin of safety for a stock this well covered and this high quality? A true margin of safety for Union Pacific rarely comes from fundamental valuation mistakes. Analysts cover every single carload. The consensus view is usually correct about the quality.
Therefore, the only viable way to get a true discount, the only true margin of safety, is by buying during cyclical overreaction. You have to be a contrarian buyer willing to step in when the news headlines look terrible.
This happens when general recession fears spike globally, or when a specific sectoral headline, like a major rail accident, a labor strike threat, or the structural decline in coal volumes, temporarily drags down the stock price.
These temporary fears create opportunities where the market temporarily forgets the permanence of the physical moat. You are buying the same quality asset at a discount simply because of short-term macroeconomic noise.
And we advise the listener to look for historical points of value entry. Historically, a price that implies a PE multiple below 18x has often represented a deep value entry point for this specific asset.
It allows you to capture the long-term quality compounding without the crippling risk of significant multiple compression. Patience is the ultimate virtue when investing in quality infrastructure.
Now we have to address the existential threats, the permanent risks that challenge the eternity of the moat. First, the structural decline in revenue from the melting ice cube risk, the death of coal.
Coal revenue, which was historically a massive, high-margin driver for UNP, is structurally heading to zero. This represents a permanent decline in a historically significant portion of UNP's carloads.
And while they have managed to offset this decline through strong pricing power in other segments, it is a persistent structural headwind that caps overall volume growth and forces UNP to constantly run just to stay in place.
But the truly existential threat, the potential game changer, is autonomous electric trucking. This is the technology that could genuinely shrink the addressable market for rail, even if it can't eliminate it entirely.
Currently, rail is overwhelmingly cheaper past a certain distance threshold, say 700 to 800 miles.
Right. But if autonomous electric technology matures, and specifically if it can drop long-haul trucking operational costs by, say, 50%, the competitive dynamic heaps entirely.
That economic break-even distance moves much further out. Suddenly, shorter-haul intermodal routes, or routes up to 1,500 miles, which were firmly rail-dominated, become economically viable for trucks.
Even without the 3-4x fuel efficiency rail offered.
Exactly. This wouldn't breach the central moat. UNP will still move the bulk grain and the heaviest commodities across the continent, but it would effectively shrink UNP's addressable market and erode its utility on the margins, stealing valuable intermodal and manufactured goods freight that makes up the premium volume.
That is the critical technological risk that requires constant monitoring of the truck technology landscape.
Despite the risks, though, there are clear, powerful growth catalysts that justify the premium valuation. The primary growth engine for the next decade is unequivocally nearshoring in Mexico.
This is the structural tailwind UNP needs to offset the coal decline and domestic GDP stagnation. UNP is positioned as the best-in-class beneficiary. As global manufacturing shifts out of China and relocates to Mexico, Union Pacific is the prime conduit for cross-border trade.
And that's now one of the single biggest volume drivers for the company.
This macro trend provides structural volume growth that U.S. domestic GDP growth alone just cannot provide.
Another potential catalyst is winning back intermodal share from trucks. As highway congestion worsens, and as the supply of truck drivers continues to be a severe structural labor bottleneck, the economic argument for using rail strengthens.
And this allows UNP to reclaim volume lost to the highways over the last decade.
And finally, the internal, controllable catalyst, operational leverage driven by Jim Vina. His stated goal is ambitious, to drive the operating ratio down to 55% from the current range of around 60%.
And if Vina achieves that goal, the impact on the bottom line is enormous. Even if revenue is entirely flat, if they don't move one extra carload, simply reducing expenses to hit a 55% RR could result in a 15 to 20% jump in earnings per share.
That's pure, internally generated earnings growth driven entirely by efficiency and cost cuts. This is the immediate, controllable earnings upside that investors are currently banking on to support the high multiple.
So we've established the consensus view. Union Pacific is a safe, boring compounder tied reliably to GDP, providing utility-like stability backed by an irreplaceable asset.
Right.
But we need to engage in second-level thinking and challenge that consensus, specifically regarding the regulatory environment.
The contrarian view is that the market dangerously underestimates the regulatory risk. The market assumes the government will never risk supply chain disruption by directly interfering with the railroad's core pricing model.
And that assumption of complacency might be the investor's greatest vulnerability.
The specific, single biggest threat is the growing aggression of the Surface Transportation Board, or STB. They aren't just a bureaucracy, they are the referee for the entire rail market and possess the power to step in and fundamentally change how UNP does business.
And they have expressed deep frustration over service quality and persistent high shipping prices.
The nuclear option the STB holds over UNP's head is the idea of reciprocal switching. For the listener, this would mean the STB forces UNP to allow a competitor, like BNSF, to use UNP's tracks for the final mile of delivery to a customer who is currently captive to UNP.
This is a fundamental erosion of the monopoly. Reciprocal switching instantly destroys the localized monopoly pricing power. It essentially transforms UNP from a fortress that can raise prices above inflation into a common carrier utility with regulated, lower returns.
This is the single largest non-physical threat capable of breaching the economic moat. If that rule is mandated, the entire investment thesis centered on pricing power just evaporates overnight.
Okay, now, let's run an inversion exercise. This is the red team challenge. How exactly could we lose 50% of our capital invested in Union Pacific, assuming the high-quality asset remains physically intact?
We start by buying UNP today, thinking we are buying a safe, dependable utility at a premium 20x PE multiple. We assume the multiple is justified and will hold because of the moat.
Then the scenario unfolds rapidly over the next 2 years, hitting UNP with a perfect storm of simultaneous external pressures. First, autonomous electric trucking technology leaps forward much faster than expected, supported by massive infrastructure investment.
Long-haul costs plummet, and suddenly trucking is competitive with rail for most intermediate distances.
Result, UNP's volume shrinks significantly, not just from the coal death, but from losing high-margin intermodal freight. Their ability to raise prices stalls because shippers finally have a viable alternative.
Simultaneously, the U.S. government, perhaps frustrated by persistent supply chain snarls and overall inflation in shipping costs, decides to act aggressively. They re-regulate the railroads, possibly mandating that reciprocal switching, or they impose an effective cap on pricing power.
And they demand service quality improvements tied to rates.
Now, UNP is stuck. It is a regulated utility with capped returns, fighting a permanent structural volume headwind due to the accelerated decline of coal and the competitive erosion from autonomous trucks. The market realizes the fortress has been economically breached.
The investment community no longer views it as a protected utility compounder. The valuation multiple collapses from the utility-like 20x down to a distressed industrial multiple of, say, 12x, because the earnings outlook is bleak and returns are regulated.
And the result? Severe permanent capital destruction. This scenario highlights that the combination of technological disruption and regulatory intervention is the only thing capable of breaching this physical moat and destroying investor capital.
Let's synthesize this intensive analysis. We'll boil down the investment thesis with our one-pager summary for you to take away.
On the bull case, the reasons to own this stock, it rests on 3 pillars. First, you are buying an irreplaceable asset. You are literally buying American geography that cannot be duplicated.
Second, you are betting on the nearshoring winner. They have the best-in-class exposure to the massive Mexico manufacturing boom, giving them a structural volume edge that offsets domestic stagnation.
And third, it is a capital return machine. Aggressive buybacks and a growing dividend create a relentless stock price floor, rewarding patient shareholders by constantly increasing their ownership percentage of a stable asset.
Conversely, the bear case, the counter thesis, demands equal attention. First, volume stagnation. Rail volumes in the U.S. have barely grown in a decade. If growth is purely reliant on price hikes, that ceiling is regulated and politically sensitive.
Second, the coal drag is persistent. A significant high-margin portion of the business is disappearing permanently. This requires constant vigilance and successful offset by the growth in other segments like chemicals and intermodal.
And third, and critically, labor relations. The strike risk, or a rapid wage spiral, possibly mandated by new federal policies on crew sizes or attendance, could crush the entire efficiency thesis driven by PSR and instantly reverse all the hard-won gains in the operating ratio, harming profitability severely.
This has been a genuinely fascinating deep dive. We've covered the tension between the eternal physical moat, that irreplaceable right-of-way, versus the new non-physical threats,
Mm.
the technological disruption from autonomy, and the potentially catastrophic intervention from the regulator, the STB.
Analyzing UNP requires you to view it through dual lenses, simultaneously as a safe, predictable, inflation-protected utility and as an industrial company under intense, ruthless pressure to maintain efficiency gains in a cyclical environment.
The necessity for the learner is to watch two key non-physical metrics that will determine the fate of this colossal physical asset. First, track the operating ratio. Is Vina delivering on that 55% goal? If he stalls at 58 or 59%, the premium multiple may deflate.
And second, monitor the STB regulatory filings, especially regarding reciprocal switching. Those are the early warning signs of moat erosion. If the STB starts pushing hard on mandatory switching, that changes the investment case fundamentally.
What stands out to me, ultimately, is the immense capital required just to keep running. The Red Queen effect, that $3 billion plus annual maintenance capex, is essential to protect the asset, but is a massive anchor on free cash flow generation.
Which leaves us with one final provocative thought for you to mull over. Given the massive ongoing capital requirement just to maintain the status quo, is Union Pacific fundamentally more analogous to owning a public highway system, where returns are inherently capped by social necessity and regulatory oversight, rather than owning a growth company driven by genuine innovation?
And which definition fundamentally dictates its long-term multiple? The 12x industrial multiple or the 20x utility multiple?
Thank you for tuning into this deep dive. We hope this analysis gives you a far richer understanding of the complex, powerful economics of Union Pacific Corporation. We will catch you on the next deep dive.